Hello and welcome to Calling Monster Finance. It's September 25th, 2025. Tomorrow's markets experienced a significant downturn, driven by a classic market paradox. Good news for the economy was treated as bad news for stocks. A wave of surprisingly strong economic data undermined hopes for interest rate cuts from the Federal Reserve, leading to a broad-based sell-off across major indices. The S&P 500, Dow Jones, and NASDAQ all closed in negative territory. The day's narrative was shaped by this collision between a resilient economy and the market's desire for monetary easing. We'll analyze the key economic reports that triggered the sell-off, examine the conflicting signals from Federal Reserve officials, and look at the sector divergences that emerged amid the volatility. Now, let's take a closer look at the final numbers for today's trading session. The Dow Jones Industrial Average closed at 45,947.32, down 173.96 points, or 0.38%. The S&P 500 index finished at 6,604.72, a loss of 33.25 points, or 0.50%. The NASDAQ Composite ended the day at 22,384.70, down 113.16 points, also a 0.50% decline. The Russell 2000 index saw the steepest losses, falling 0.98% to close at 2,411.04. Wall Street stumbled today as investors were forced to fundamentally reprice risk. The prevailing market narrative, which had been built on the expectation of monetary easing from the Federal Reserve, was shattered by a series of robust economic reports. The day's trading was not a simple pullback, but a direct reaction to data that dismantled the case for imminent rate cuts. Stronger than expected GDP figures, low jobless claims, and a surge in durable goods orders raised the specter of a higher-for-longer interest rate environment. This macroeconomic shock was compounded by mixed messages from Fed officials and rising political uncertainty from Washington, creating a challenging environment for investors. Today will be noted as a session where the market's dependence on monetary stimulus was tested, revealing a far more complex and uncertain outlook. The primary catalyst for today's market downturn arrived at 8:30 a.m. Eastern Time, with a volley of key economic reports that painted a picture of a U.S. economy that was far from cooling down. First, the third estimate for second quarter gross domestic product was revised sharply higher to a 3.8% annualized growth rate. At the same time, weekly initial jobless claims fell to 218,000, well below expectations and contradicting the idea of a softening labor market. Finally, durable goods orders for August surged by 2.9%, crushing forecasts that had anticipated a decline. This trio of strong data directly challenged the market's core thesis that a slowing economy would justify further Federal Reserve rate cuts. The market's reaction was immediate. The 10-year Treasury yield, a key barometer of rate expectations, rose to close at 4.17%, as bond markets repriced for a more hawkish Fed. This sentiment was quantified by the CBOE Volatility Index, often called the market's fear gauge, which jumped 3.46% to 16.74, signaling a sharp increase in investor anxiety. Adding to this uncertainty were conflicting messages from Federal Reserve officials. Chicago Fed President Austin Goolsbee warned against front-loading too many rate cuts, while Kansas City Fed President Jeff Schmid stated that the current policy stance is the right place to be. This public division within the central bank left investors with no clear policy signal, amplifying market volatility and contributing directly to the day's sell-off. Overlaying the day's economic data was a significant degree of political uncertainty emanating from Washington. The increasing likelihood of a U.S. government shutdown weighed on sentiment, particularly after the White House instructed federal agencies to prepare for permanent job cuts, a notable departure from past procedures. President Donald Trump's ongoing public criticism of Federal Reserve Chair Jerome Powell also continued to influence the market. This created a paradoxical situation where investors feared both political pressure on the central bank and the potential removal of that pressure, which had previously fueled hopes for rate cuts. The president also confirmed his intention to approve a deal involving TikTok and announced that tariff revenue would be used to assist American farmers. This combination of a potential shutdown, pressure on the Fed, and ad hoc trade policy announcements eroded institutional predictability, forcing the market to price in a higher premium for political risk. Meanwhile, in a market dominated by broad selling, Elon Musk focused on company-specific developments. A major strategic alliance was announced between his AI company, xAI, and the Trump administration, making its Grok models available to all federal agencies. On his social media platform X, Musk also taunted Tesla short sellers. However, despite this cultivated narrative, the hard data shows Tesla was a significant underperformer today. The stock closed down 4.38%, losing $19.4 per share. Its massive trading turnover of over $41 billion, the third highest of any stock, confirms its status as a market battleground, but also demonstrates that even a powerful narrative is not immune to formidable macroeconomic headwinds. While macroeconomic forces set the negative tone, a key earnings report provided a granular view of anxieties surrounding consumer health. Both used car retailer CarMax delivered a disappointing second-quarter report that sparked concern across the consumer discretionary sector. The company reported earnings per share of just 64 cents, which was a significant miss from the consensus analyst estimate of $1.03. Revenues also fell short, coming in at $6.59 billion against expectations of $7.05 billion. Management described the quarter as challenging, and investors appeared to view the report as a potential warning sign for the health of the American consumer, particularly in the middle and lower income brackets. The results from CarMax fueled concerns that consumer spending, a key pillar of the U.S. economy, may be weakening under the pressure of higher interest rates and persistent inflation. Beneath the headline index declines, today's session revealed significant structural divergences, signaling a potential shift from a market driven by broad trends to one that rewards individual stock selection. Looking at the S&P 500 sectors, the performance was widely varied. The energy sector was the day's standout leader, gaining 0.87%. In stark contrast, the healthcare sector was the biggest laggard, falling 1.67%, followed closely by consumer discretionary, which dropped 1.46%. Interestingly, the information technology sector, the market's undisputed leader for much of the year, finished the day nearly flat, with a marginal gain of just 0.03%. This flatness, however, masked deep divisions within the sector itself. For example, Oracle shares fell sharply by 5.55%, and Meta Platforms declined 1.54%. At the same time, other tech giants defied the trend on company-specific news. Intel surged an impressive 8.87% on reports of potential investment talks with Apple. Apple itself also showed strength, rising 1.81%. This highlights a market that is growing more discerning, punishing firms with perceived weaknesses while rewarding those with clear, defensible catalysts. Now for the 5 most actively traded stocks by turnover. Number 5 was Apple, which gained 1.81%. Number 4 was Nvidia, which rose 0.41%. Number 3 was Tesla, which fell 4.38%. Number 60 was the NASDAQ 100. 2 was the NASDAQ 100 ETF, the Invesco QQQ Trust, which declined 0.43%. Collisions, the most actively traded security, was the S&P 500 ETF from SPDR, which closed down 0.46%. In summary, today's market action was a clear reflection of the good news is bad news dynamic. Strong economic data fueled concerns that the Federal Reserve will keep interest rates higher for longer, leading to a broad sell-off in equities. The session was marked by rising bond yields, a stronger U.S. dollar, and increased market volatility. Divergences at the sector and individual stock levels suggest investors are becoming more selective in a complex macroeconomic environment. Looking ahead, market participants will be intensely focused on the upcoming Personal Consumption Expenditures, or PCE, price index release. This report will be a critical data point in the ongoing debate over the Federal Reserve's future policy path. If you found this analysis helpful, please hit the like button, subscribe to our channel, and share this video with your friends. The content provided on this channel is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investment decisions should be made with independent due diligence and in consultation with a qualified professional. While we strive to ensure the accuracy of the information presented, we cannot guarantee its completeness or correctness. Any risks or losses resulting from the information on this channel are solely the responsibility of the individual. The views and opinions expressed in this video are those of the speakers and do not necessarily reflect the official policy or position of this channel. This content is not an offer or solicitation to buy or sell any financial instruments.